Yeah, good morning, everybody. Good to be here. I'm nearly there. Yeah, good morning, everybody. Great, that's super. Everything's set up. Great. Well, we're starting the session looking at our dominant currency sentiment pair for the day. Now, sentiment has broadly remained supported this morning. So the risk on sentiment that we've had in the market is still present. We had some decent earnings through the European session so far this morning. And so far, the market is looking through these US-China tensions in terms of closing one another's consulates. So it's definitely an area to watch. But at the moment, we still have equity markets moving higher. Just taking a look here, we can see equity markets pushing S&P 500, Dow futures, NASDAQ, DAX, volatility dropping. We have FTSE 100 rising, Euro stocks, ASX 200. So all the equity markets are pushing higher. Bond yields are sort of remaining supported and are sort of stuck in quite a narrow range, but they're certainly not making new lows. So the yields are sort of broadly supported on the day, which is supporting the risk sentiment. In terms of commodities, we've had oil supported, copper prices supported, and obviously gold prices have been moving up into that big overhead resistance level that's here. You can see that's the all-time high resistance level. And I just took my final gold position off in that level. You know, the chances of breaking through there without some kind of pullback are unlikely. Of course, anything is possible in trading, but at this stage, I'm looking for a retracement to rejoin this potential move, and another move back down, and then a retest is the most likely option in the gold market at the moment. So I just took my profit anyway up into this R1 level. See the price getting, when I saw that heavy profit taking here, that was a signal for me just to take my profits. But the commodity markets are broadly higher. So we do have that Australian dollar, Japanese yen bias. The Australian dollar tends to be supported on the risk of on tones. We have the high beta currencies like the Aussie and the New Zealand dollar being supported. Also the commodity currencies like the Canadian dollar is supported as well. So that's why we're also expecting Japanese yen weakness. In the risk on markets, we see Japanese yen weak flows on the risk on tone. So we've been looking at this area here, the 76.50, as a potential area to take along. And you can see that that's not a bad little area there. We also see that that is just coming in, just testing a trend line on a very small trend line on the hourly chart. You just see the price is pushing there. So that's not a bad area to be joining longs. And we just want to put our stop just below that 75.76 handle. So it's the ADR low for the day. And also we've got the 75.98 region would be a good area for stops. So that will be the sensible place to leave that stops. And obviously, if we saw risk sentiment change, the risks to this trade are that we do see risk sentiment turn off and we see the equity market start falling, commodity markets falling, and obviously that would harm the high beta Australian dollar, and we'd see inflows into the yen, and that would negate this trade. We would, of course, update you and let you know as soon as that is or isn't the case. So just be aware of that. Targets, if we're entering here, the first near-term target will be up here, that 76.80 region, up towards that 76.90 region. So just below that big round number, the 77 handle would be the obvious first target. The other options is to wait to see if that risk sentiment carries on. The reason for waiting is we will look at this event in a little bit of time, but we have the initial jobless claims coming out of the US, which has a high potential of guiding risk tone. So we have this big overhead resistance here, this 77 handle that price just closed away from back in June. So just to be aware that we've got some pretty big levels here. And you can see that the size of these levels, this strong overhead resistance that is very, very, very key level. So just got to be aware that we're trading up into that very key level. As a result, we need to be extra cautious because of that level. But of course, if we see that level break higher, if we see that break higher above, then we can look for buying on pullbacks where if and when we see a break of this. If we see a break of this R177 level, we could then look at a retracement back up to the 77.50. You can see that's the next sort of overhead target would be 77.50 if and when that level breaks. But as it stands, that's what we're looking at. That's the current play, a dominant currency sentiment, high probability pair. And of course, if that sentiment changes, we will update you and let you know. Now, in terms of daily risk events, don't forget that as we go into, don't forget how to use the must read tab. Very, very helpful tab to use. Of course, you have the terminal here, the dashboard, which can be a very helpful tool just to keep everything in one place, get the latest video commentary, and you get the latest trade idea, must read section. And don't forget, you can also flip back and just hit the sentiment stream and have the terminal exactly as it was before. So you've basically got the choice of how to use the terminal. In the must read section, always don't forget the daily risk event outlook. It's very key and very helpful today. Just lets us know the key macro drivers. So in things to be aware of, the first thing to be aware of, obviously, COVID-19 concerns, as always. Rising cases in the US continues to be an issue for the US. It's weakening the US dollar, and until the stimulus package is agreed, that's a continual risk for the US dollar, just weighing on that US dollar. We've seen the dollar index, that's what I see, continually been dropping over the last few days. So we just, even going down that weekly chart, you can see here on that that trend line break to the downside, just moving down to that 95 near support. So that's dollar weakness is continuing. Don't forget, we've got a key support level here. So again, watching out for profit takers, and any potential action at that level is possible. Certainly, if we see a risk sentiment change, we could see a little spike in the US dollar, given those strong support levels we're falling into. This China versus the West rhetoric, the market so far has kind of looked through this, particularly with the closing of consulates in US and now a retaliatory closure of a US consulate in a province of China. So at the moment, the market's looking through this. Obviously, got the US elections coming up, so there's expected to be some kind of posturing, particularly from Trump, who's really developed this anti-China rhetoric. So he'll be wanting to max out on that in anticipation of the elections coming up for the US. So far, the market's looking through this, but tensions are starting to rise. We had that Hong Kong legislation rejected by US, Canada, EU, UK, Australia, pretty big nations. So this is an area to watch. And if it does worsen, this has the potential to sour the risk tone. So be aware, very much aware of that while you're trading. Brexit. Now, particular risk we have for today, we have Michel Barnier speaking at 1 p.m. today. So that is a risk for the pound. So be aware of that coming into the session, and just be flexible. Could provide an opportunity with the pound, and it could also just be a non-event. Either way, it's something to be aware of. That is coming 1 p.m. UK time, which is 1 hour and 20 minutes time. So that's on the way. It's certainly something to be aware of today for the pound. The other major risk event that we need to be aware of is the US jobless claims. Now, this has the potential today to really form a catalyst. Now, you can see that these continued jobless claims have been sort of reaching this kind of plateau, this base, and that starts, that's going to start to be a concern for the US, that the fact that as other states have ramped up their lockdown, some have had to go back into a lockdown mode. These jobless claims are now staying up quite high. So in terms of the actual data points, continued jobless claims is expected to come in at the initial jobless claims, I correct myself, is expected to come in at 1.3 million. So if we get a maximum, anything above that maximum of 1.5550, 1.5 million, 1.6 million is going to be a concern for the market. And we've got the FOMC meeting next Wednesday, and we've got NFP jobs approaching. So if we keep seeing, if we see these elevating above those maximum expectations, that will be a concern for the market. Of greater concern is going to be the continued jobless claims. We just close that for a minute, we'll come back. Looking here at the trend in the continued jobless claims, we have been seeing this level dropping week by week, which is what you're expecting as the markets, as the US markets start operating. But as we know, the US is, in a second wave of COVID-19. Either, doesn't matter how you turn it, whether it's an extension of the first wave or a distinct second wave, still cases are growing. It's going to be a concern. And of course, it's a concern because if it results in more joblessness, because more companies can't open, more people are being laid off, less people are able to get to work, it's going to create a problem for the US economy. The US economy is consumer driven. Around 70% of its GDP comes from its consumer. And of course, consumers can only spend if they have a job. So this is the importance of the US continued jobless claims data. And looking in terms of minimum maximum expectations, the expectations is 17 million. The maximum expectations are 17.5, minimum is 16.6. So quite a narrow range compared to some of the ranges we've had of late. But anything above 17.5 has the potential to alter the risk tone. So we want to see, for a potential risk tone to be altered, we want to see initial jobless claims, above 1.5 million, and continued jobless claims above 17.5 million. Alternatively, if we got figures that are better than expected, underneath that 1.2 million for initial jobless claims, and underneath the 16.6 million for continued jobless claims, that's likely to boost risk sentiment. And that's likely to keep this risk sentiment, moving forward and moving up into the session. So that's certainly something to be aware of as we approach the US jobless claims, and certainly something that could really move this Aussie yen currency pair around. So just to be aware of that coming up at the second half of the UK trading day. So that's the key things for us to be looking at. I'm just going to be working through our question and answer session now as we go through. And if you've got any questions, please do ask away, so that you can communicate just using the chat and the question and answer box if this is your first time on the session. Yeah, good morning, Anant. Yes, doing good, thanks. Between trading currency pairs, indices and commodities metals, which one has less manipulation, fake outs and whiplashes and tends to trend more? Oh, that's a great question. They have different seasons. Sometimes the benefit of trading a commodity, like commodities and metals, is sometimes it can be more straightforward, because if you're trading a metal with a strong upward bias, like we had in copper recently, it can be a fairly straightforward commodity to trade because you're just trading copper. With sometimes with a currency pair, you've got to think about two different aspects of the trade. So sometimes just having a simple commodity can be easier to trade. That's what I find anyway. If I'm trading gold, silver, copper, it's just one thing to think about. So I do find that easier. In terms of trading currency pairs, obviously the major currency pairs are easier to trade than the minor currency pairs. Indices, again, indices can be straightforward as well in the sense that they tend to move with that risk tone. They're very sensitive to risk. So there can be sort of a simplicity for trading indices, given you can focusing just on the current risk tone. In terms of what has list manipulation, fake outs and whiplashes and tends to trend more, you know, it's really difficult to take. I find currency pairs can be quite volatile. Yeah, and I would, you know, I would go commodities. I would go metals, commodities, indices, FX. That's the order I put it in terms of the less kind of volatile moves. Oh yeah, high beta currency? High beta currency is a currency that attracts investors, and in a time of global risk sentiment being on, the high beta currencies, which offer a higher interest rate, like the Australian dollar, New Zealand dollar, traditionally, they tend to gain. So that's why the Aussie and the New Zealand dollar are called the high beta currency. It's just a shorthand for, you know, currencies that tend to rise in a risk on market. Yeah, the average daily, could I explain the ADR indicator and why you use it? Yeah, the ADR indicator is just a really helpful kind of indicator which tells you the average daily range for a pair. So you can use it because it just lets you know that if price moves above the average daily range, you know it's an extraordinary move. So you use it just as a reference point in order to know how far the pair has moved, how far does it have to move to its ADR, what is its average daily range, and just give you a sense of, you know, context of the market moves. Hi Anna, how high do you think Euro US dollar will hit? Well, this is an interesting one. Now what's interesting about the Euro US dollar? Oh, that's a nice big fat trend line there, isn't it? We're coming into. So, you know, that would be an obvious, that 1.1650 region would be an obvious target coming up there. Now, looking at the euro, the reason for this euro upside has been kind of this optimism of the European Recovery Fund. And what has been interesting is I was looking at the spread of the options for the Euro US dollar over the next couple of weeks. And the spread of the options are skewed towards the call bias, which is basically the buy side. So the market is positioning itself for further Euro US dollar upside. So certainly, you know, ultimately where it go, you know, I don't know, but I am do prefer a medium-term upside bias in the Euro US dollar. So
in 10 minutes time, be top of the hour. Look out for the lead.
I would favour buying the dips, but in terms of where it ultimately will go, this is a key level here up at that 1.1650 level in terms of overhead resistance, and we have a series of call side options which are basically banking on higher prices. So I think there is a bias certainly for the market to buy the euro moving forward. Yeah, Jimmy, I've noticed that bond yields are dropping, and I have that as a risk-off indicator based on US 10-year. Any thoughts on why they are dropping, but risk sentiment is staying risk on? Yeah, Jimmy, you know, at the start of the year, one of the big issues was, you know, why is the US 10-year bonds dropping, the yields dropping, but equity markets rising? Let's just see. So let's just, yeah, okay. So and let's compare. We'll put that a different color so it's easier to see. Right. So there we go. So at one stage, you see here at January, we had the US 10-year yields dropping, but you had equity markets rising. Okay, so that was a signal, and the signal, I remember writing an article about this on the Time for Forex Live, is, you know, which one's right? Is it the equity market that's right and that these are optimistic times, or is it the bond yield market this is right? There's a time of pessimism coming. Now you can see that the bond market was the correct market. Okay, so you can see here again, you've got this similar divergence. You've got, look, you've got S&P 500 moving up, but yet the bond yield market moving lower. Now, when you see a divergence between these two like that, what the general rule of thumb is that the bond market tends to be right, because the bond market has macro investors who are investing on a much larger time frame. And that larger time frame it means they have a sort of a different view, Jimmy, a more longer term view. So the general rule of thumb is when the equity market and the bond market diverge, the bond market's right. So, which is what would say, there's a lot of commentators that I'm reading that are getting very concerned about the rise in stocks. And they're kind of saying like, you know, this rise in stocks is not corresponding to economic reality. There's a number of different voices saying that. Now the market can remain irrational, that's for sure, but eventually, you know, things tend to sort themselves out. So it's a good observation, Jimmy, and it's just showing you, it's a slight alarm bell essentially in your mind. So in terms of like trading our day-to-day sentiment, like you know, it's not a crucial issue, but in terms of just being aware of what's going on and, you know, the wider picture of the market, it's an important thing to just take a note of. So it's something that, you know, I'm taking a note of, and I'm just thinking, hang on, is this, and I'm talking medium term here, Jimmy, I'm not talking about today, because obviously intraday trading is very different, but medium term, you're thinking, actually, it feels like we're due a correction in stocks, and a number of market commentators are just kind of adding to that voice. So, you know, your observation is right, and I think Arno's been doing a few videos on this in the terminal, so do check him out. He's been talking about, you know, bond yields and equity markets and how they flag up differences. So do check that out, Jimmy. It should be in some of the recent videos. I think he was doing some yesterday and just pointing that out, that little, you know, that little divergence that was in play. Oh, sure. I just hope you're well. In today's trade idea, buy euro pound long, entry at 0.9144. Let's just have a look. Yeah, today's trade idea. If the bias is upside, why wait for 0.9144 and not just buy it now at 0.91100? Best Sharia. Yeah, Sharia is a couple of things there. Obviously, you've got the comments coming out from Chief EU Brexit negotiator Barnier at 1 o'clock. And sometimes, you know, you might just want to wait for a technical break to confirm your bias, which is, you know, legitimate. But then sometimes you can just trade. Let's find the euro pound chart. Sometimes you can just trade the, you know, you can just trade the bias, as you're saying. So if you look here on the daily chart, look, you see here, you've got that ascending trend line. Okay, so now we've got an upside fundamental bias for the euro pound. So the question is, Sharia, now, how do you trade this? So I do different things. So with my gold trade, which I've been flagging up here, I flagged it up on the Monday before I got in. It was very similar kind of setup to this. And I was just buying on stop because that was confirming my fundamental bias. Now, in this case, the euro pound, I've bought in down here. I bought in, where did I buy in? Let's have a look. Yeah, I bought in down here at this 0.90 level, around 0.9088. So that's where I bought in anticipation of a break to the upside. Now, if you get a break of this level, and see, I'm looking at the trend line, I'm looking at a break there, you see. If you get a break of that 0.9144, then that's a technical trend line upside break. So that's why I'm, looking for that 0.9144, and then that just gives you a little bit of upside. And then if, price moves back down into this trend line over the next like 2 or 3 days, then I'll be, reviewing the trade carefully, because the fundamentals and the technicals aren't marrying up. So I'm trying to get the fundamentals and the technicals working together, Sharia. So that's why if you look on the trade idea, it said long euro pound from market and or on stop of 0.9144. So when it means from market, what that means, Sharia, is you can buy it at current prices. Okay. So in the trade setup, the trade idea does give you that option to buy at market, but obviously you've got the extra risk of Michel Barnier speaking at 1 o'clock in just an hour's time. So you might want to wait for that. I've just moved my stop to break even down here at the 0.90990 level, and I'm going to see what happens. And then if price breaks above these highs, then I'm either going to enter another position on buy and stop, or maybe wait for a pullback and have a limit order to buy in, tomorrow or maybe next week. So that's how I'm sort of playing that one, Sharia. Hope that helps. Horatio, would the US dollar remain pressured whether the jobless claims miss or beat expectations? Now, if the jobless claims is a bad miss, we potentially could see some risk-off sentiment come into the market. So if the risk sentiment goes strongly off, then the US dollar will act as a safe haven currency. I'm not entirely sure, Horatio, how the US dollar will act after the jobless claims miss, if there was a miss. I'm not 100% sure. It depends on the level of concern. So if there's the deeper the concern, the greater the alarm, the more like the US dollar is going to strengthen and operate as that safe haven, as it has done recently alongside the Japanese yen and the Swiss franc. Now, if it beat expectations, I'm expecting more US dollar weakness. Okay, that's a bit more straightforward for me, and I expect that risk on sentiment to march on. And good morning. Yeah, any particular reason for not choosing New Zealand dollar Japanese yen long instead of Australian dollar Japanese yen? Thinking that New Zealand has COVID in control as Aussie does not at this time. Thanks. It's probably just the recent good sentiment there's been for the Australian dollar this week, and New Zealand dollar Japanese yen would have been a legitimate choice as well. So sometimes, it's a toss-up between the two of them. So, it's just probably because we've had Governor Lowe saying he's not worried about the strong Australian dollar. We've had the strong rise in commodity prices supporting the Australian dollar. We've had the RBA talking, against negative interest rates. This week, we've also had this income support scheme extended by the Australia's government this week. So there's been a number of, supportive features for the Australian dollar. Certainly no reason not to do the New Zealand dollar Japanese yen. And as you've said, the New Zealand dollar does have COVID in control. Just it's not a major focus at the moment for this for an intraday trade. Okay, so that's probably some of the rationale. But say if you said to me, I prefer New Zealand dollar Japanese yen over Australian dollar Japanese yen, no problem. Oh, good morning. Let's have a look. Question here from Morning. How will an escalation in the US-China tensions impact the dollar Swiss franc? Right. If the US-China tensions really accelerate and become a major market concern, then we expect risks off sentiment to come back into the market, and we'd expect to start seeing this US dollar strength. So we'd expect to see US dollar Swiss franc upside. And that's if there's a severe escalation. Both the US dollar and the Swiss franc operate as a safe haven currency. So what would happen is that if it went to extreme risk off, we'd have, I have to make a correction there, Molly. We'd have extreme risk off. We have US dollar and Swiss franc, both of them will have strength come into them. So we would have a neutral bias on this pair. And we have a neutral bias on this pair at the moment. And if there were strong US-China tensions, we would still have a neutral bias pair. You tend to get this whippy action. If you just have a look on the chart, you can see, you know, since June, you've had this range between 9,550 and 9,350-ish. And that range has just been choppy action as both of these currencies act as a safe haven. Sorry for the confusion. Why does the Aussie and New Zealand dollar have higher interest rates? Their economies have been doing quite well, particularly out of the global financial crisis. I know Australia did particularly well with the strong rise in gold prices. They're a large gold exporter, and that really did help the Australian economy coming out of the global financial crisis. Devan, if we've got jobless numbers missing expectations by a big amount, how long will the risk off sentiment last? Okay, first question, Devan, it's impossible to tell, but you would certainly expect it to last the session or until some other risk sensitive news came along. And would dollar be expected to appreciate on risk off? Yes. Considering all of the mixed messages coming from the market, isn't it more likely that any move to risk off is likely to be faded pretty quickly, as the market doesn't seem to be paying much attention to bad news? Everything seems to be out of sync lately. Devan, you're absolutely right. There has been this bias towards discounting bad news. So, you know, we've kind of been seeing that a little bit, even this session. The US-China tensions develop and they grow, but yet the market's kind of looking through them. So yeah, the market has that bias to look through the bad news. I guess the question is, how much longer can that carry on? So yes, the only problem with jobless numbers is if a serious concern is that the US consumer is going to be in trouble, that's something that can turn the market. Because it's the US, about 25% of the world's GDP comes from the US. So essentially, if the US does badly, the rest of the world does badly because of that strong, you know, economical connection between the US and other nations. That's particularly why, you know, a bad number on the jobless numbers is less likely to be looked through. It's something that's more likely to the market to pay a lot of attention to. But that bias to ignoring bad news, Devan, is you're absolutely correctly. You're absolutely correct. Oh, no, you have so many chart templates. Could you give us a quick run around, say why they have them, what you look at them for, and how they help you out? Thank you. Yeah, sure, Nan. Okay, so first of all, this is your major currency pairs. So here we have the major currency: Aussie, Euro, Pound, New Zealand US dollar, dollar Canadian dollar, dollar Swiss franc, dollar yen. And then I have the dollar index. Okay, these are the major pairs. They're the most liquid currency pairs. So ideally, if you can take a trade, you want to be taking a trade on those major pairs because it costs you less in terms of commissions and fees. So first, that's the, you know, the heart, the meat and veg, the heart of your trading. And you've got the dollar index here as well. Now we've got the dollar index because 70% of all currency transactions in the world involve the US dollar. And you'll see that when the dollar rises, you'll see the major pairs fall. When the dollar sinks, you'll see the major pairs rise. So always nice to have a look at the dollar index. Here, just got you know, some of the, you know, the daily currency sentiment pair. Got that euro pound trade idea. So this is more like a working template. Got some you know, different indexes up here. Got some major equity indexes. So it's just sort of a little bit more of a working chart, that one. This one is futures markets. So just can see at a glance what's happening in the US and the UK and Asia Pac, as well as the VIX. So VIX is basically like a fear sentiment. When markets are worried, the VIX goes up. When markets are calm, the VIX goes down. So when the VIX is going down, that's when you also tend to see equity markets rising. So looking at the future markets as well, because obviously the S&P 500 doesn't open now to a couple of hours. So the futures markets just let you know how things are, looking in the US markets ahead of the open. And of course, you've got the European markets here as well as the Australian market. So that just keeps you tied into indices. Then here, just got bond yields. So this is the major 10-year bond yields, and just lets you know what the bonds markets are thinking. Helpful again for risk, because if you have bond yields rising, that's positive for risk. Bond yields falling is negative for risk. So that's why you're looking at the bond yields. And then finally, you've got some commodities. So you've got WTI and Brent crude, and you also get copper prices. Again, when markets risk on, you see these commodities rising, the general rule of thumb, and obviously got gold as well. And at the moment, when risk sentiment is on, you see gold rise as well at the moment. And that's the main templates that I'm using. That's a quick tour. There is a video that you can look here. I think it's I think if you just go to the video and search Trading View, you can have a little look at some videos here and then, which just helps with a bit more explanations about Trading View and using it. Oh, you're very welcome, and no problem at all. Ariel, if the Fed buying bonds raises stock prices indirectly due to flow of capital, would higher bond prices and lower yields be less impactful on risk tones in this current environment? If Fed buying bonds, just going to read your question again. If Fed buying bonds raises stock prices, yeah, would higher bond would lower bond yields be, would higher bond prices and lower yields be less impactful on risk tones in this current environment? I'm just having a think there, Ariel. If the Fed buy bonds, raising stock, okay, would higher and lower yields. Well, there's I'm thinking, Ariel, if I've understood your question correctly, Ariel, I don't think it's going to be less impactful on risk tones, because I think what the market wants to see is that will there be low interest rates on borrowing for the foreseeable future? And will the Fed be coming in to keep those bond purchases going, to keep bond yields low, to keep that environment suitable for businesses to grow? So I wouldn't think it would be less impactful on risk tones in the current environment, if I've understood your question correctly. Okay. Okay, guys. Well, that's gone through the session today. Yeah, good. Okay, I've got your area. Thank you very much for the session, everybody. I will be back tomorrow, not tomorrow, it will be down with you tomorrow. I will be back on Monday for our usual session. So have a good rest of session. And before I go, don't forget that Brexit speech at 1 o'clock, that's key. And don't forget the initial jobless claims, which, you know, could be a catalyst for risk tone. So just keep your eyes, you know, on that going forward. Okay, guys. Yeah, cheers. Thanks, James. Take care, everybody. Goodbye.